This is the market rundown for the week of October 14th. We had a couple of items that came in last week. Continuing jobless claims came in. It was better than expected. You can see the actual is at 1867. The market was expecting 1870. So better numbers there. And then the retail sales came in better. The consensus was 0.3%. The actual was 0.4%. Some of that you wonder how the hurricanes affected anything, people buying, knowing that the hurricane Helene was coming in and maybe it amped up buying. We really won't know until we see next month's number. But both of these numbers, basically all the news that comes in is showing the economy is doing quite well, better than expected. It makes you wonder why the Fed cut rates the way they did last month. You can see interest rates being affected the way with this news. So, you can see bonds going up, and then really since September 19th, which is right around the time that the Fed cut the rates at a jumbo rate, you can see bond yields go up and bond prices come down. And this is very interesting. Stanley Druckenmiller did an interview with Bloomberg. I'll put the link below this video, but I would recommend listening to it. It's very interesting. His viewpoints are really very similar to mine, and he very critical of the Fed of the way they're cutting rates, the way they did, and really they're just taking their cues from forward thinking. And if you look at the market, how it's responding, the market just keeps going up, up, and up, and it really makes you question if the rate cuts were really warranted. And then we start looking at the predictions from financial analysts of, most of them believe that another rate cut is going to happen by the end of the year. I wouldn't be shocked if that doesn't happen, but that could stun the market. We'll talk about more of that later on. But ultimately, you can see rates just going up and the bond prices coming back down, which is very interesting. When you look at the overall market, you can see that the market has broken out above this triangle. And, if the Fed is going to cut rates, or at least if the market thinks the Fed's going to cut rates, you have inflation that will remain higher than expected. But I wouldn't be surprised if you see the market continue going up. That would completely shock me. I'm not making a prediction here. It'll be very interesting how the market plays out. I can see some consolidation here, then maybe an uptick later. My overview of the outlook is that the market has to come down. I'm not saying that's going to happen in the next 3 months, 6 months, year, but when you just see the inflation is staying higher, the Fed really cutting rates, sooner or later, you think that if inflation is higher, that the Fed would have to raise rates. And at that point, you're really going back to the 1970s, 1980s policy. And if you look how the market responded then, drastic falls during that time. Again, I would highly recommend listen to the Stanley Druckenmiller interview, as he lived through that. He was investing through that time. It's a very interesting take. So here's the S&P 500. When we take a look at the NASDAQ, we can see it hasn't broken out of its triangle, although it very well may do it next week. We'll see. But this actually probably looks a little better, in my opinion, than the S&P 500. As you see, it's not exactly overbought or quite as overbought as the S&P 500. Next week will be interesting. These are obviously all short-term moves, but when you start looking at the longer-term fundamentals of the S&P 500, this is where what I was saying that I'm ultimately worried, because here's the Shiller P/E ratio. Now, this is different than the regular P/E ratio where you just have price divided by earnings. The Shiller P/E ratio takes effect. It takes account of the last 10 years of earnings, and then also takes account of the inflation rate. So this is more of a true ratio where the P/E ratio isn't. So if you look at this, you can see where we are. We're approaching all-time highs. No shock. This is during 2021, right before the market really crumbled during that time. And you can see we're approaching it. We're getting near all-time highs. The historical average you see down here is 17.5. So we're well above that average. This is just showing that really the market is, in my opinion, overvalued, really where it needs to be. So in the long run, it'll be interesting to see how this plays out. But in the short run, I wouldn't be surprised if you see some consolidation. It could tick higher, and really, elections coming up, how the Fed responds. We'll see what happens. You don't know how the Fed is playing political games with the election coming up. So anyway, so that's it for this week. We'll see you next week.